you like write one of the best blogs on the planet, especially on the topic that we're going to cover. So yeah, I don't know. I feel like a lot of people, including myself, would consider you basically the leading expert on all of this
Oh, you're
stuff.
making me blush. I can't possibly be true.
I am definitely not the first person who said these things to you, but we'll go with that. So if it's cool with you, we'll just dive in because we have a bunch of like I think really interesting things to ask you about.
Fantastic. Let's do it.
Okay, cool. The first thing that I'm going to ask you is what is like the key SaaS metrics that you care about most when evaluating a company? Like you get a deck, what's the page you're flipping to? What's the first thing you're looking at?
Yeah, great question. First page is the team. No question. Is the team. Like
Yeah.
what is the background of the team? Why are they uniquely suited to solving the problem that they're solving? The second is really around like the size of the market opportunity is really important. And so that may not necessarily be a metric, but it's just like, okay, if it works, how big is it going to be? And the mistakes that I've made, and I've made more than I can count, have always been on underestimating the market size of companies. And so when I look at that slide, I really have to push myself to be imaginative on how the business could create a market, right? So before Gainsight started, what was the market size of customer success software? Zero, right?
Yeah.
So you can't just look at that side blindly. And then you go, I mean, you rip through the deck and look at all the different metrics. The first three metrics typically you're looking at is ARR growth, and you're kind of looking at the first derivative of that, so the change in bookings and what this looks like. The second is around net dollar retention. I think that's the second most important. And then the third is sales efficiency. So what does it cost to buy another dollar of ARR? Those are the three like big level ones, and then there's 5 or 6 at the next level.
I can't help myself but ask you on the market opportunity thing. It seems so much an art rather than a science because you don't want to be under imaginative, but you don't want to be over imaginative either, right? Like, how do you find? I don't know. Is this just like a skill you honed over the years, or how do you sort that out?
Yeah, so there's this awesome book called Super Forecasters, written by a researcher named Tetlock, and he talks a lot about. And Enrico Fermi was one of the men who designed the atomic bomb, and so he had to deal with probabilities. And he has this way of breaking down problems. Like he found that the super forecasters, the people who were super accurate, they would think about a conditional probability. So let's say, Sidharth, you and I were going to start a new company, and we're going to make software for tire companies. I don't know, let's pick something random, right? There's some base number of tire sellers, and so we should start with that, right? And then, what's the probability that we can raise a series seed, and then what's the probability that we can build some software? And those are probably 100%. Like you and I, no problem, we can raise that round and build a software. And then the question is like, okay, looking at the team and looking at the software, sort of what probability do I think I'm going to assign to the fact that we could get like the top 5? What is that going to look like? Right. And what probability do I think we could get 10% or 15%? And if we're really successful, what probability do I think vertical SaaS maybe get 30 to 40% market share? That's conceivable. And then you kind of take a look at that and you're like, okay, like in the success case, this is what the company could be worth. And so that's the way I kind of think about it. And then the other thing, Bill Gurley wrote about this or talked about this. He talked about how there are certain companies that expand the market, certain companies that compress the market, and certain companies that keep the same, right? And he's a specialist in marketplaces. Marketplaces compress markets, right? And so that's another thing to look at. Like, is this software what is it going to do? And so you need to think about that too.
Um, there's this that makes sense. It seems like it's sort of like on a bottoms up, what percentage of this thing that you capture in the bottoms up. But I'm sure you're pitched sort of like the entire market size of tires being sold in America is like
Yeah.
this much larger number, and we're, I don't know, gonna take some cut of that or something. I don't know, like we're gonna have this innovative mechanism, and it's gonna like be sitting in all these parts of the value chain, take some cut of it. How do you think about that?
So it can be so let's say in our tire business, the initial software was inventory management, right? And the first bit of software was just managing inventory. How many tires are coming in? How many tires are going out? there, if I were to pitch that business, I would pitch it as a subscription company, and the market size would be some fraction of the IT budget of those shops. And if I wanted to get a VC really excited, what I might pitch is, after we have the inventory management part, we're going to start dealing with AP and AR, right? Accounts payable and accounts receivable, and we could start being in the payments flow and factoring. So we might lend in order to mitigate cash shortfalls. And at that point, all of a sudden, the total value of all the tires sold in the market is relevant to the TAM conversation, but not before.
Right. Right. Um, so let's imagine this tire company is, at Series B, Series C. You're like, oh, this team's the tire and software experts of the world, and you're starting to look at recurring revenue and growth rates and NDR. And let's say the CEO is pitching you. Uh, Not me, because I don't know tires, but let's say a different CEO is pitching you. And how much do you expect? Like, how much do you care that they know all of these things off the top of their head? Like, do you view someone more positively because they can rattle off all the numbers off the top of their head? Not really. Like, how do you think about it?
Yeah, having incredible command of your business is a huge asset. It is a huge asset because, especially at the Series B and the Series C, you are making a bet that the company has developed a money making machine, and that more dollars makes the machine spin faster. And so sometimes, I mean, it used to be 10 or 15 years ago, it was very common for a CEO to bring a CFO or a VPF into a pitch. Now you
Yeah.
never see it. And it's surprising. Or like a chief of staff or the head of data analysis, because I would, if I can ask you some random question, like in the tire business, what fraction of your revenue comes from enterprise accounts worth 100K in ACV or more, right? Most CEOs will probably have a good guess. But then if I ask, how does the net dollar retention of that cohort compare to the other three cohorts? What you're likely going to say is all that information is in the data room, which is a fine answer. But if you're able to say, like, actually the NDR is 40% higher, it just goes that much further in demonstrating your mastery of your own business.
Yeah. I could totally see that. Like, you know what you're doing because you care about that number, and that means that you've thought about it and are probably doing things to manage it.
Right. Exactly. Exactly.
Yeah. Um, do you like in your head, do you have benchmarks for some of these things? Like, I won't touch a business that's, or I will always like look at it more carefully if A, B, and C are above D, E, and F.
So I have benchmarks in my head, and it comes from a survey we ran in 2020, looking at we looked at almost 600 companies from seed stage all the way to public companies, and we got a lot of data. And so, like, sales efficiencies, I know what to look for, and AE quotas, I kind of know what to look for. The thing that's happened though is it used to be that SaaS companies were far more homogenous in their go-to-market strategies. And I think with more competition or just more players, people have become more experimental.
Hmm.
And so with benchmarks, it's easy to kind of keep a closed mind. Like, I recently learned about Samsara,
Mhm.
which is now a publicly traded company, and they went to market in a very different way. So, most companies, like the typical SaaS company, let's say you're selling a 20 to 40K ACV business, you're probably targeting a sales efficiency of like 0.4 on the very low end to kind of 0.8 or higher if you can, which means a payback period of like 14 to 18 months. And you're going to continue to operate and hire salespeople provided your pipeline to quota ratio is kind of in the 3 to 5 range, which means it kind of implies like a 15 or 20 to 33% close rate from a second stage sales lead. Samsara did it a very different way. They emphasized longer term contracts, and they wanted, the bar that they wanted for their account executives is that the account executives would pay for themselves in cash every year.
Hmm.
So if you're paying your account executive $175,000, they just needed to close $175,000 in gross profit, and that was success. Whereas the typical startup would say, actually, for an inside rep, we want them operating at 550 to 650. Right? We want 3x ARR to OTE ratio. And this sort of cash strategy means that your payback periods are quite long. But as long as the multi-year contract lengths are longer than the payback periods, totally fine. And the churn rates are low, you're totally fine. And so that enabled them to grow really, really, really quickly and sort of delayed the quota increases and the focus on efficiency until they were at a much larger level of scale.
That's
And
wild.
yeah, I've been wondering actually, we work with one business that's doing this and it's doing it marvelously well. And I've been wondering as there's more and more competition in SaaS and the willingness for the enterprise and mid-market buyers to commit to multi-year deals, whether or not we're going to see this strategy more, because it's actually far less capital intensive than a classic software business. And if you operate the business on a cash basis, like you can finance a lot of your own growth. In fact, you might even be able to borrow debt in order to finance it. There are certain providers that now do that. So all of that is a really long way of saying there are certain benchmarks, but what we're seeing is more heterogeneity in go-to-market strategies in order to compete and get an edge in the market. And you can't have blinders on to say I only look at businesses that are 30K ACV with 0.8 sales efficiency.
That's fascinating. On the samsara story, were they getting paid upfront for these multi-years, or are they getting paid upfront for these
Some fraction
multi-years?
of it was upfront. Yeah,
Okay, so they're getting some of that financing from the customers.
exactly right. Which is what I mean. Salesforce pioneered the annual prepay, right? Which is a loan from your customer at a 0% interest rate.
They
So
just took
why
it
not?
further.
Right. If you're just doing it for 1 year, why not do it for 3 or 5?
Yeah. Oh, that's so fascinating. And so that's what allows both the like quota coverage to be lower as a ratio of the salary, and allows you to sort of be able to have more money to fuel into the business. Okay. That
Yeah, exactly
makes
right.
sense.
So now all of a sudden, instead of having 10 AEs, you might have 40 AEs for the same spend,
Yeah.
which means you're building the brand faster. You're getting the compounding efforts of having all those people on the street. And so you push the bet that you're making is eventually you'll be able to get to that same level of efficiency to be on par with other software companies. Um, but I think you kind of look at the number, well, we can all look at the number of successful software companies. At this point, you can have a pretty high degree of confidence that you can get there.
Yeah. Yeah. Hmm. Actually, what do you need to have that degree of confidence though? Because like sometimes you could just have a broken model, and you
Yeah,
don't want to, you don't want to push it too far, only to realize later and then have to hit the brakes.
totally. Well, I mean, so, for a lot of these, most software companies typically start out in the SMB, and then they're
Mhm.
looking for a modest level of efficiency there. Then they build enough features to move into the mid market. And so you're really looking for being pulled into the mid market and then seeing some greater efficiencies at that point, maybe in year 2 or 3 of the go to market. And at that point, you should have relatively high confidence.
Yeah. And by being pulled into bin market, you mean like your ACVs are now starting to get closer to 50K or something?
Exactly. You nailed it.
Yeah.
Yeah.
Yeah, cool. One thing I think about is like something that makes that sort of samsara type model really work really well is if your customers just never leave, right? Because
Yeah.
then your LTV, or however you want to think about it, is really good. But the other thing I wonder, can a high NDR also make that type of model work? So let's say maybe you don't have like the most incredible retention. Maybe it's not 99.9%, maybe it's 90%. But if your NDR is really good, could you make them? I don't know. Curious if you've come across any examples.
I haven't come across examples. I think it would not be crazy if you had sort of like Snowflake like 170% NDR and your logo churn was say, like you said, 90% or above, and you were going to remain within that segment for the next couple of years. I could imagine people taking that bet.
Yeah.
It's probabilistic in a certain sense, right? Because there's some discontinuity in the business. You could really end up upside down on the economics,
Yeah.
right? Where you've paid out commissions on stuff that's not never going to actually see the light of day. So you need to be
Yeah.
really careful there. But I think if you had a pretty good longitudinal data set at scale, I mean, you think about like the usage based companies like Twilio and AWS.
Yeah.
They sign up a customer. They don't know what that customer is going to generate. They've got some
Yeah.
probabilistic estimate of what that LTV is going to be or the ACV is going to be even for the year, and they're
Right.
they're paying commissions on it. So again, they're doing it at the 1 year time interval, and at some point, some brave entrepreneur and some brave financier are going to get together and and magic will happen.
As long as the times are good.
Yeah.
Uh, um, in the past, you've shared this idea that NDR that's just 20% higher can be like how valuable it can be for a company. I'm wondering if you can elaborate more on that idea.
You bet. So Einstein said the most powerful force in the universe is compounding interest. And it's never more apparent than in a software company. So the net dollar retention of being 20% higher, it's like 5x, 4 or 5x 3 or 4 years later in terms of the difference in ARR. And that just, you can kind of look at like a 20% increase, not that much in a year. I imagine having that conversation with your head of customer success, just saying, I just need you to get 20% higher on the NDR this year and then 20% higher. And then all of a sudden you wake up and you have a business that's 4 or 5 times larger than it would have been had it stayed at the standard NDR. Hugely powerful. And it all comes down to that compounding effect. And I think one of the reasons, I'll take this on a tangent, one of the reasons that software companies used to be priced like 8 times forward multiple in the public markets was the 75th percentile. It was not broadly understood, these compounding dynamics. And then the other thing that's really become apparent, it was a fantastic blog post, I'm not sure who wrote it, was how long software companies can grow at like 50, 60%, way longer than most other businesses, and they can sustain those growth rates. Big part of it comes down to NDR and account expansion.
Oh, that's fascinating. So one thing that's interesting to me, because in part because of what we do at Subscript, is the compounding nature of this. Because most of the time when companies report an NDR number, it's not cohorted, and so it's unclear whether that's year one NDR or year three NDR, or like the question being, does it actually compound, or is it like a one shot thing?
That's a great question. Most investors were blind, right? Unless you're a private market investor and you ask for that data room and run the cohorts, there's not that level of public reporting yet. It's only relatively recently, maybe in the last 4 or 5 years, where even in the IPO filings, you have some notion of net dollar retention. And then the definitions actually vary across companies. So like Box and Zendesk only report NDR above 5K ACV, for example. They don't report
Mm,
it below that threshold. And there are meaningful differences between enterprise NDR and mid-market NDR. In fact, a survey that we ran showed that the median net dollar retention for in enterprise companies, selling products of 100K or more, are significantly higher than the ones in the SMB, which was counterintuitive to me. I mean, in retrospect, it makes sense that if you land with one department at Walmart, then you can cross-sell the entire team. But on a
yeah.
percentage basis, I thought like if you land with one seat in a 20-person company, you can grow that account 19x. But not true in practice.
That's super interesting. Is it because like so many of the latter churn that it just like some of them do go to 19x, but 19 go
Yeah,
to 0x?
I think that's definitely a part of it. I think another part of it is the willingness to pay in enterprises, right? It's like a
Mm,
4 to a 10x on a per seat basis if you sell to an enterprise relative to a mid-market company because of all the security, the compliance, or just pricing power that you would have.
yeah. Hmm. Um, on the NDR reporting front, there was I think it was Snowflake that had a particularly interesting NDR number where I think they only counted it after year one or something, because like I think companies start at zero-ish spend at the beginning, and then like they like year one I guess stabilized. I don't know. I thought that was really interesting, and I wonder if for usage-based companies, if that's like the right model, like look for stabilized and then go for NDR from there.
Yeah, I haven't looked at that specific metric, and I probably shouldn't comment on Snowflake because we're still investors. But the
Uh-huh.
I do think it makes a lot of sense that you would look at it after the first year because there's so much volatility in the number, right? The
Yeah.
customer could churn,
Yeah.
and it's probably not a good long-term indicator of the health of the account.
Yeah. Um, you talked a few minutes ago about when talking to founders and trying to understand like NDRs at the enterprise level versus NDRs at the SMB level and stuff like that. In general, are there things like that where you're like, oh, I wish founders were able to go deeper on some of this stuff, but like you don't necessarily see it yet. Like you wish they knew as a group of people.
Yeah, I think at the early stage, the thing that's the most important is if you can have three examples of customers that expanded, and you can go deep in explaining why. The story behind the champion, why it is that they expanded, what were the use cases, how did it grow? the more granular the details, the more tangible it is, the more effective the pitch. So it's not necessarily on the
Yeah.
metric side that's really important. It's that storytelling and the knowledge of the account, because that really helps. Um, it really helps equip your champion inside of the venture firm. Because I remember, when I was coming up in the firm, like I would go and I'd find an awesome company, and I would go and pitch it to a partner or not. And today, another one of my partners, and they're gonna ask me immediately for the use case. And if I have a story or two or three stories, like this is the way Netflix uses it, and this is the way that Google uses it, and this is the way that Stripe, whatever. It just really grounds it, and then it helps people imagine what a business could be.
Yeah. I guess as a venture investor, you're only partly sometimes investing in the numbers, but so frequently investing in the story that's going to drive the numbers.
Yeah, less and less. I mean, gosh, I was looking 2019. I ran benchmarks on all the companies that we had met, and what the median ARR was at the Series A was at 1.1 million to about 1.5, with a pretty big confidence interval that took it to like zero point 0.6 to 1.7, and
How
that
come?
number's come way down, way down. I mean, we're talking like, uh, yeah, zero. Sometimes we're talking like 30K, 50K in ARR, not MRR. Um, And so you don't have it's quite rare to have any significant data. There's no pipeline, there's no historical conversion rates. So what you're really trying to do is you want 3 to 5 customers that you can call, and you want to hear those stories in the pitch, and then call those customers and have them echo the same feedback. Make sure it's consistent, and then it's easy to draw a line.
Yeah. When you do have more data to work with, are there things there than you wish that that founders had a greater grasp of?
I think cohorts are really important and underappreciated.
Hmm.
And understanding of why certain cohorts are performing, whether it was tied to a particular feature launch or the hiring of a VP sales or something else that happened in the market. I think cohorts broadly are underused in order to understand businesses. That's
Yeah.
one big idea.
Yeah. Do you have a like this might be a hard question to answer, so you can pass if you want, but do you have a thing or an example of something that you think people would do differently if they were more focused on looking at their business on a cohorted basis? Like what would they do better?
That is a good question. That's a really good question. Okay, I'm going to make a leap here. So I'm not sure this is quite true. But my hypothesis would be, I think companies that move really fast, particularly at the early stages, have a huge competitive advantage with the execution speed. And I remember meeting this one CRO who took a company from the very early stages all the way through IPO. And on Mondays, he would bring his team together and he would kick off the meeting, the one on or the stand up or whatever, with the week number in the year. He would say, "We're in the 36th week of this year, and there are 52 weeks." And in that way, he was able to drive urgency even through July and August, and it just kind of gave you a sense that time was running out. And I wonder if the management teams and boards looked at cohorts more frequently, that they would be able to drive that same set of cadence. Like, okay, let's look at whatever this month's numbers and then next month's numbers. And it also ties, why a lot of sales execs have moved to from quarterly quotas to monthly quotas. It's to drive like a repeatability um, and a faster cadence in the business.
Yeah,
There's no
I
hiding.
like that. Well, I like that in part because once a month passes or a quarter passes, that cohort is done. That's
Yeah.
it. You can't add anything to it. And yeah, you can like grow that cohort over time, but the initial it is what it is.
Yeah.
Um, I also like that from like it's a very clear separation on the acquisition and then the sort of retention side of things in there. It's like the cohort is now closed and now it sort of has moved into the territory of your success team.
That's a brilliant insight. Yeah. And you want to be able to influence that cohort midstream, right?
Yeah. Yeah. And so you have a team that does that. Yeah.
Yeah.
Hmm, that's good. See how it all works. Now, cool. Then the next thing that I wanted to ask you about is you talked late last year about two types of payback calculations, one on sort of a GAAP revenue basis and one on a cash flow basis. I was wondering if you can expand a little bit more on sort of like why those two and how you think about it.
Yeah. So this goes back to the Samsara example. So most businesses look at it
Mm,
on an accrual basis and they say, let me look at the life of the contract and figure out how many months of that contract is it going to take to pay back. And the funny thing is, then it's probabilistic too, because most companies operate with gross margin normalized payback periods of 14 to 18 months, which means if you sign a 1 year contract and the customer churns, you've lost money on that customer. But with the logo retention high enough, it all kind of works out in the end. The cash based payback period is when you're just, like an AE being paid $150,000 only needs to bring in 150K and they've hit quota. And again, as long as you have a high degree of confidence in the durability of those contracts, then it really allows you to scale out quite nicely. Um, and so there's an advantage. I think there's a competitive advantage if you can do that, but you do need to make sure you absolutely need to make sure that the logo churn is quite low.
yeah. It this once again intersects with our role. It seems like your confidence in the integrity of your data is like absolutely critical here, right?
Critical. And so you need a sophisticated sales finance function. You definitely need a deal desk, which is when the CEO, the CFO, and then the head of sales come together and look at the construct of a contract to determine whether or not it's viable. One company I worked with, we tried this promotion and we didn't think through it, and we ended up doubling burn for a quarter because the cash flow dynamics were terrible. So having that sales finance function is really important. And then the last thing that you really need is a really terrific sales training program, because you're going to be hiring account executives at a clip that's 2 or 3, maybe even 4 times faster than the classic SaaS company would. And when you're making that kind of investment, if you're not generating enough pipe or you're not onboarding the AEs, the impact to cash burn, it can really turn quite quickly. And so you need a lot of sophistication, or at least a lot of instrumentation, to understand exactly when that's going to happen. And again, like that's why you would look at cohorts. You look at AE quota attainment cohorts in order to understand that.
That's so good. Is there like, do you think of a what is the example of a canonical company in your head that is primed to have that finance function start being built out? Like, when should people be like, this is me. I should be building this thing out. Like, I need sales finance and I need a deal desk and I need someone to like model out all of these scenarios before we, flip that switch.
Yeah, in my mind, you want to hire that function right when you have your first sales team, so a sales manager and 3 to 4 AEs. All of a sudden, particularly if you're a lower ACV company, something like 15 to 20K, your deal velocity is going to be high. You're going to want to grow really nicely and continue to hire. And you'll probably hire another sales manager, and then you'll have 2 sales teams up to maybe 14 AEs, because you really want to maintain 7 AEs per manager. And so if you get that sales finance person in, they're going to take a quarter or two to build the model, understand how the team works, and really give you that instrumentation, so that when you hire that sales leader and now you're going from 14 AEs to something like 28 AEs, you've instrumented the organization and you're ready to go, because a mistake at greater scale is that much more expensive.
Yeah. I really like your point you made there. I feel like AE ramp and SDR ramp is like an incredibly well understood concept, but when you hire a finance person, they also got a ramp.
Absolutely, they have to rent, and then the business is going to change underneath them at the same time, right? So there's
Yeah.
things change a lot, and so there's complexity, but absolutely, and they need those relationships, right? It's not, a lot of people look at finance and say, oh, it's plug and play, but it's not that. You really want a sales finance person to sync with the sales leader and understand how they work together and develop those processes before you scale.
Yeah. Last question, which is somewhat unrelated, but Subscript is a totally asynchronous company, so we're like a very very heavy writing culture and
Love it.
commenting and like asynchronous discussion type of culture. And you wrote a piece about like why you prefer Google Docs instead of Google Slides in board meetings, and that like really resonates with us. So I wanted to hear you talk a little bit more about that.
Yeah, I one of the reasons I got into writing is it really clarifies your thought. They say if you want to learn something, teach it to somebody else. And there's this awesome concept. There was this called the illusion of explanatory depth. There's this Italian artist, and he went to I think it was 50 or 100 people, and he lives in Italy. And he went uh, to a big place, maybe in Rome, and he asked 100 people to draw a bicycle, a functioning bicycle. And then he built models of 16 of those drawings. And you want to guess how many of them actually worked? It was only one or two.
I mean, I'm shocked even that bicycles are
Yeah,
complex.
right. And so there's this sort of human bias that we all have, which is the more familiar we are with something, the more we think we can explain it. But in reality, it's quite difficult, and we take a lot of details for granted. And writing breaks that. It breaks that illusion because in order to make a cogent argument, in order to distill a letter, right, like the Twain quote of the letter would have been shorter if I had more time, you have to spend time on it. It's got to be clear. The flow has to be really clear. And so if you're going to um, if you're going to take lots of people's time, condensing it is really valuable. We met this with this other company that was doing metrics analysis for meetings. It was a spin out of Bain, and Microsoft ended up buying the business. And I'll never forget, they had this stat. There's a big Fortune 500 company, and the average number of people in a meeting was 50. And then the other stat was, crazy. And the other stat was there was the CEO at the time asked for a weekly meeting on Friday to gather a certain amount of data. And they calculated that single meeting, which was 20 minutes long, cost the company 50,000 man hours a year because of the cascade, right? And so if you're taking that amount of time, like, or a management team meeting where you're taking 8 hours of management time, you can calculate it for your company, how much that costs. You really want the content to be distilled and clear. And I think what ends up happening a lot of time with presentations, you can look at the Challenger disaster or whatever. What ends up happening with a lot of the presentations is there hasn't been that investment to clarify the thought and really boil down the 2 or 3 key issues. So constraining people to 1 page, maybe 2 pages max, to talk about the top 2 or 3 things and elucidate the issues is a really good exercise to make those meetings more powerful. I mean, we all complain about being in meetings, and it's because very few of us, and I'm just as guilty as anybody else, do the preparation in order to maximize the value for
Yeah.
those people. And so, the written document, the 1 pager is one path, right? Not the only path, but one path to getting people to consistently distill what it is they want to convey.
Yeah. And as a board member, this is like, I mean, you basically have the most expensive time in the company in that one meeting. And then you have outsiders who need to like absorb all this context and hopefully give great advice. Um, so that makes
Yeah,
total
that's it.
sense that like, yeah.
Yeah. There was this awesome, uh, you know, being a CEO of a company is a very difficult job. I think underappreciated how difficult it is. And there was this awesome interview with Barack Obama in Vanity Fair when he was president. And they, kind of the quips around he wore the same thing every day and didn't want to fatigue his brain making inconsequential decisions. And they asked him, that was kind of a lead up question to the big question, which was, what is a day in your life like? And he said, every meeting is an impossible decision because all of the decisions that could have been made by other people have been made by those people. And so only the impossible decisions come to me. And if you're going as a CEO, I mean, you're not operating on the sort of the nuclear launch code scale, but
Thank God.
but within your own world, you're making the most important decisions for that company, right? And all the people and the welfare of your employees. And so another reason why I like the written form is, again, like you don't have that much, you will get tired if you're inefficient with your time and you can't focus. And so the written format, at least for me, it really helps you maximize your decision-making ability.
Yeah. Since we're almost at time, I just have one last question for you, which is our audience is primarily Series B, Series C, CFOs, VPs of finance, directors of finance type of folks. And just any last word that the words that you might have for them, or any last piece of advice that I did not get a chance to ask you about that you would offer?
Yeah, I will say, I think and I wrote a blog post about this. I think the most underappreciated function within a company is the head of finance. I think they are in a position to be the consigliere, which is really the advisor to the CFO, and their unique view on the business through the lens of a spreadsheet or the FP&A function is, I think, dramatically undervalued. And so I would say the later stage CEOs, make sure you have an incredible consigliere, because they will help you see around corners in ways that most people need, but very few appreciate.
I couldn't agree more. I feel like that role and the head of people, without those as a CEO, you're
Yeah,
dead.
yeah, for sure. I think Michael Moritz had a quote which said, "The startup business would be easy if it weren't for the people." In other words, it's the interpersonal stuff that really challenges companies.
I feel like those are the two. Once you have an amazing those two, everything else can fall into place.
Absolutely.
Thank you so much. We're so thankful for this.
This is a privilege. I really appreciate the invitation.
Thanks, Tomasz. I hope you enjoyed today's episode. Before you go, let me give you a super quick overview of what Subscript is, because chances are we can help you. I started Subscript because in my last business, I had this problem. We had this giant Google spreadsheet, and that's where we kept track of everything about our business. And if you're anything like me, you're a data-driven leader who really cares to understand numbers in order to make sure that you're making the right decisions. But when you're looking at a giant spreadsheet with lots of just tabs on tabs on tabs and lots of people with access, you're probably not looking at the right thing, because you can never be confident that someone didn't mess something up, or that someone didn't fat finger a number, or that you considered all the corner cases that you actually needed to consider. So that's what Subscript does. We help you understand your subscription business at a much deeper level than you ever thought possible. If you'd be interested in giving it a try, come check us out at subscript.com.